Hello, good morning. And today is Wednesday, January 4th, and I am Kenny Polcari, your host of the party. And what's happening today? Well, the year did not get off to the start that we all wanted, right? The mood turned sour after Tesla and Apple pre-announced slowing demand, as if that should surprise anybody. Fed minutes are due out today. What will we learn, if anything new? I say absolutely nothing. Oil took a hit yesterday. It's all about the demand destruction story all over again. Like they won't quit with that. Gold pushing higher, testing 1900. And what do we have for dinner tonight? We're going to try the Shcarola and Beans soup. And we'll talk about that in just a moment. So it's not really the way you wanted to start the new year at all. Stocks gave up an early morning pre-market rally to end the day lower. Although not on the lows of the day, which were fairly significant, but lower as well. The Dow lost 11 points after swinging 537 points from high to low. The S&P gave up 15 points after swinging 84 points high to low. The Nasdaq lost 80 points, but it swung 304 points from high to low. The Russell lost 11 after swinging 48 points, and the transports actually rose 6 points after swinging 240 points from high to low. Now, the positive move turned sour when Tesla revealed that they delivered fewer vehicles, 405,000 versus the expected 420,000, which was an average estimate despite significant incentives in their biggest markets. The deliveries, by the way, were a quarterly record for Tesla. That's good, isn't it? But it did fall short of the 50% increase they were aiming for. It was also the third straight quarter that they missed deliveries, that caused a bevy of analysts to cut their price target on the stock. Current 12-month price estimates range from a low of 85 to a high of 450. The median is now $250, which is 132% higher from where it closed last night. Now, what baffles me is not that they haven't punished Tesla over the past 12 months. They have. The stock was down 65% in 2022, right? Think those sexy growth names under the Fed rate increases, right? The turbulence that causes. Yet after yesterday's headline, Tesla traded down another 15% to $104.64 by midday, only to rally into the bell and close at $108, or a 12.5% loss on top of the 65% loss suffered in 22. Here's where it goes off the rails for me. They clobbered the stock over the last 12 months. Then yesterday, they pre-announced a record number of deliveries. Earnings report is not due out until January 25th in a challenging environment. Nonetheless, and the algos weren't satisfied, and they took 12.5% more out of the name. Much of the miss was sales in China, or lack thereof, to which I have to ask you, have you not realized what has been going on in China? They were welding doors and windows shut, forcing people to be jailed into their homes, right? Think of that zero COVID policy, which has failed miserably. And you're surprised that Tesla missed on deliveries in China? Missed by 15,000 cars? The way they sold the stock yesterday, you thought they missed by 200,000. Tesla is now trading at levels last seen during the height of the original COVID crisis in June of 2020. Just saying. Now, and then we heard from Timmy Cook, right? CEO at Apple. And he's telling Chinese suppliers to make fewer components for AirPods, watches, and MacBooks for the first quarter due to weakening demand. I say Timmy's sourcing components from other parts of Asia or the world. And he's playing that woe is me card with the Chinese, right? Think COVID policies, think about disarray. Foxconn is Apple's biggest supplier. And while Shenzhen, China is their biggest hub, they also produce components across the world in Thailand, Malaysia, the Czech Republic, South Korea, and Singapore. So my gut says that China's in such disarray that Timmy's trying to move sourcing to other countries. So therefore he's telling China, oh no, demand is lower, so you should stop making parts, right? I, for one, am not buying the slowing demand story for Apple products at all. Partly because, first of all, I thought maybe the original estimates were too high to begin with. Just like Tesla, right? They were overly optimistic. So think about this. If you estimate that you're going to deliver 10 units and you only deliver 8 units, but that's up from 6 units last year, is demand really slowing? I mean, come on, think about that for a minute. Which is also why I only buy Apple on the down days and don't chase it on the up days. It's always better to let the sellers come to you versus the other way around, right? Now, There have already been 5 downward revisions to earnings per share estimates over the past month in Apple, with earnings per share coming in at, or expected to come in at $1.93, although the range goes from $1.82 to $2.09. If it comes in at $1.93, that would represent an 8% decline in earnings per share year over year. But we know that. It's in the public square. And by the way, it's been a challenging environment. And if the Fed has a way, it's going to get more challenging. So just be patient. This is Apple we're talking about, not Lehman Brothers. In the end, the algos were stunned, unable to reconcile what's been going on, right? But let's be real. What will they report this quarter in revenues? 82 billion, 85 billion, 100 billion? In any event, it's still an obscene amount of money that they print on a quarterly basis. So let's not get absolutely crazy. Earnings are due out on January 27th. 2023 revenues are expected to grow by 3% to $405 billion. But let's just see what they say. My gut says that this is just another overreaction, that the pendulum has swung too far to the left, and before you know it, the arc's going to begin to come back to the right. Apple was down 28% in 2022, was down another 3.7% yesterday. It's trading at levels not seen since May, June of 21. I think Timmy's buying some insurance for when he reports on the 27th. He'll surprise to the upside, right? Everything will be fine. But hey, that's me. You do you. And then the conversation turned to the Fed minutes being released today. What would they say? What will they reveal about who is worried about that sticky inflation that we don't have is going to linger longer than expected? The minutes are supposedly going to suggest that many members expect inflation to be higher at the end of 2023 than they previously thought. Now, the current year-end inflation estimate is now 3.1%. That's up from 2.7%. A significant decline from where we are now at 7.1 and where we've been at 9.1. So what's the issue? The issue is, what will the Fed have to do to get us there? Is the current schedule of rate increases enough, or will they need to keep raising rates into May versus the expected March pause date? And if they raise the inflation target from 2 to 3%, then boom, it's all good. But what will have to happen to unemployment? That's going to be the question. How high will they have to force it to go? In the end, one day does not make a trend. And it's not like we didn't know all of this, unless, of course, you've been living under a rock. And then maybe you didn't know all of this. Now, oil, which was trading above 80 yesterday, got whacked, right? Falling 3.8% or $3 a barrel after testing near trendline resistance at 82.30. What happened? Well, think about the Fed minutes all over again, and a slowing global economy and the potential for ongoing intensified rate hikes, blah, blah, blah. Right? See my comments above. Listen to my comments above. It's the demand destruction story all over again. It's exhausting. And recall yesterday's the IMF, right? Monday's IMF warning of a tougher 2023, suggesting demand destruction as a major global economy is going to recession. All while that Reuters poll showed that that many analysts suggest that prices will average $89.37 a barrel, which means that it has to trade substantially higher at some point this year in order to get the average to that level. So get ready. Right now, we remain in the $74, $82 price range. And gold, well, that's on the run. It's up another $18, trading at $18.63 an ounce, up 13% from the November lows. We're now above all three trend lines and appear to want to test 1900 that I pointed out yesterday, so sit tight. In this case, patience is very much a virtue. And yes, the Treasury market is still inverted as yields continue to rise. The 3-month note is now yielding 4.35%. That's up 10 basis points from yesterday morning. So you could roll money every 3 months and get guaranteed 4.35%. The 2 years yielding 4.38 and the 10 years yielding 3.7. This morning, U.S. futures are higher. At 5:30 this morning, Dow futures were up 90 points. The S&P up 16. The Nasdaq was ahead by 75. The rest up by 10. But this is the way it began yesterday before they turned south. All right. But let's remain optimistic. Eco data today includes mortgage apps. What are we going to hear about that? We hear that real estate in Manhattan is, cratering, but it is what it is. ISM manufacturing expectation of 48.5. That's still in contractionary mode. And the JOLTS job openings, it's expected to show more than 10 million job openings. And don't forget, The FOMC minutes at 2 p.m. European markets are all up better than 1.25%. Inflation figures for Germany were better than expected, coming in at 9.6%, down from better than 10+%. So that's a positive. France is due to announce today, while Italy is out tomorrow. European investors are also awaiting the Fed minutes as if they're going to reveal anything new, of which I already told you they are not. The S&P closed the day yesterday at 3824, down 15 points. Calls for a test lower remain the most popular narrative. I'm in the camp that we test the October lows of 3490 at its worst. Others are still suggesting 3,000 or 3,200. I think that's a bit dramatic. Now, that being said, the path forward is still full of potholes. So you have to just prepare yourself. And speaking of potholes, how's Kevin McCarthy doing? The House has now held 3 votes for Speaker, and he isn't winning. For me, the disgust is that the GOP has had 8 weeks to prepare for this moment, yet they screwed it up. You'd think that they would have had this all buttoned up for yesterday's vote, but no, that was not the case. And then they want to know why Americans are disgusted after they voted to spend another $1.7 trillion that we don't have. Now, keep your eye on the ball, right? As if you're a long-term investor, you just want to eliminate the noise, stick to the plan, put your money to work, or just hold it here on the side in cash and get ready to put it to work. Investing, remember, is dynamic. It is not static. You need to create that well-diversified portfolio that's going to weather the storm. Remain alert, because any sense of closure on any one of the issues facing the market is going to create a positive headline, and the algos are going to eat it up. Okay, and if you want a copy of my fourth quarter commentary and 2023 outlook, send me off an email and I'll be happy to send it to you. Shcarola and Beans soup. That's what we're having for dinner. Now, it's a simple yet heartwarming dish, but in an Italian house, you'd call it Shcarola and Beans. Because that's just what you would call it. Now, for this, you need olive oil. You need diced pancetta. You need celery ribs that are diced. You need a medium onion that's diced. You need 3 cloves of garlic that you've sliced up. You need the 2 medium russet potatoes peeled and cut into small cubes, right? You need 3 16-ounce cans of cannelloni beans in the water. You need 1 head of escarola washed and chopped. You need chicken broth, about 6 cups. Homemade chicken soup would be better as long as you strain it. You need salt and pepper to taste, 1 small Parmigiano Reggiano rind, plus you need the Parmigiano cheese for when you serve it. Now, in a heavy pot, saute the pancetta and olive oil over medium-low heat until most of the fat renders. It's going to be about 10 minutes. Next, add in the celery and the onions and continue to cook for about 5 to 7 more minutes until the veggies just begin to get softened. Now add in the cubed potatoes. Cook that for another 5 minutes, stirring it frequently. Make sure that you get it all mixed up with the oil and the pancetta fat. Now I'm going to add in the garlic, cook for 2 more minutes or so, then add in the chicken stock, right? Put in 6 cups of chicken stock and take that rind from the Parmigiana cheese, drop that right in, and open up the cans of beans and add the cans of beans, right? Bring that to a boil and then turn the heat down to simmer. Let the soup simmer for around 15 minutes or so. The potatoes have to really cook, but it should, if you've cut them small enough, it'll be 15 minutes. Using a wooden spoon, you want to mash some of the beans and some of the potatoes against the side of the pot to help thicken the soup. You can also take a couple of ladles and run them through the food processor and pour it back in. Now you're going to add the escarola and you're going to cook it until it's tender, right? Once it's tender, it only takes 3 to 5 minutes. It wilts right away. Season it with salt and pepper to taste. If the soup is too thick, you can either add more chicken stock or a little bit of water just to bring it to a desired, more soupy consistency. Remove the cheese rind and serve it in bowls and drizzle with a little bit of extra virgin olive oil on top and the grated Parmigiana. Make sure that you have plenty of crusty Italian bread. Maybe it's toasted, maybe it's just, the big, thick, crusted Italian bread, because you're going to use that to dunk in the soup, to eat, after you eat the soup, you're going to kind of move it around the dish and eat it. It is so good. But it's a home-cooked meal. It's like going to your grandmother's house, right? There's nothing super fancy about it, but when you eat it, it's going to feel good in your belly. In any event, today's going to be another beautiful day here in South Florida, about 80 degrees and sunny. So until tomorrow, take good care.